All right. Good evening, everyone. So, first of all, welcome everyone to Global Online Kannada. From today, we will be starting with the very important chapter and very important unit, that is accounting and financial management, and in which we will be discussing the very important MCQs on marginal and standard costing and variance analysis also, right? So this session will be very important for those students who are preparing for the upcoming UGC NET examination or the SET KSET examination, right? So it is beneficial for the both, if you are preparing from the commerce or if you are preparing from the management background, because this chapter is both in the both streams it is common, right? So I suggest each and every students, please watch this video till the end, because these MCQs are very important and this will be beneficial to increase your score in the examination, right? All right. So without getting late, let's start with this session. But very important thing I would like to share with you all, if you are preparing for the upcoming examination and if you want to increase your score in the exam, we have come up with the paper 2 complete course for management and commerce students, in which you will be guided with the experts. You will have all the material, all the necessary things which is important to crack this examination and increase your score in the exam, right? You will be getting complete video lectures in this course, right? And these video lectures will be completing your whole syllabus of paper 2. Complete syllabus notes will be provided to you. Mock test will be taken. PYQs with explanation will be provided. Doubt clearing sessions will be there, and marathon sessions also will be there. Okay, so this is complete package to crack this examination. If you want to crack this examination, if you are preparing for the first time or second time, whatever it is, you will definitely crack this examination. Just join this course, contact on this number. You can do WhatsApp message or WhatsApp call and join this course. Okay, all right, good. So just say yes in the chat box, we'll start with the session. Okay, I need interaction with you all, guys. Just say yes in the chat box, we'll start with the session quickly. All right, so let's start with the first question now. Okay, first thing, I would like to tell you, these sessions will be totally in the English. So people who are preparing in the English language, it will be beneficial for you, especially for the KSET students. Okay, if you are planning to prepare for the upcoming KSET examination from commerce or management background, this session is for you. Okay, so now onward, all the sessions of management and commerce will be taken by me. Clear? Okay. Good evening, Dimple. Welcome. Okay. So first question on your screen. Try to answer the question in the comment box. Okay. First question. Contribution per unit is defined as. Okay. So contribution we know. So what is contribution? How it is calculated? The formula is given. The right formula is given in the option. So you have to choose the correct option. A, selling price minus fixed cost. B, selling price minus variable cost. C, selling price minus total cost. Or D, selling price minus semi variable cost. So what is the correct answer? What is contribution? Contribution is nothing but the selling price minus variable cost. Okay. C, this is the formula. Contribution is equal to selling price minus variable cost. Okay, so this amount contributes to the covering fixed cost and then profit. Okay, I'll explain you how it is. Fixed costs are not subtracted when computing contribution per unit. Why? See, for example, imagine you sell one product. Okay, you're selling one product which is anything, and from the selling price, okay, you first minus the variable cost. From the selling price, you need to minus the variable cost, correct? And whatever it is remaining, that is called contribution. So when we minus the variable cost from the selling price, you will get the contribution, correct? Why we call it contribution? Because it is contributing. Okay, it contributes first to the cover the fixed cost. So whatever the fixed cost, you have to cover it, right? You have to cover it by selling the product, then you will matched with the fixed cost, right? And then you will calculate your profit, then you can make the profit. For example, okay, if the selling price is rupees 20 and variable cost is rupees 12. So what will be the contribution? Contribution will be your 8 rupees, right? So contribution is nothing but your profit. Okay, I'll explain you how. So fixed cost is 800 rupees, right? Fixed cost is rupees 800. Getting it? So if you want to make a profit, you need to match to the 800 rupees. So how you will match? You must sell 100 units, right? You must sell 100 units, which is 800 divided by 8. That will be your 100 units, right? So just to cover the fixed cost, you need to sell the 100 units of your products, right? You will sell 100 units, you will get the 800 rupees fixed cost. You profit, your matching with the fixed cost will be correct. Getting it? So contribution will be 8 rupees, right? First you need to match with the fixed cost, then you will make a profit. Getting it? This is the thing you have to by heart this formula, right? याद कर लो ये formula, very important. Contribution is selling price minus variable cost, right? So we need to match with the fixed cost, so that is why we need to calculate the contribution. Once we calculate the contribution, then you will match with the fixed cost, like how much unit you need to sell, right? And then your profit will be there. Next, margin of safety, MOS we call it in a short. Margin of safety in rupees is defined as A. Break-even sales minus actual sales. B. Actual sales minus break-even sales. C. Fixed cost minus variable cost. Or D. Contribution minus fixed cost. What is it? Dimple, you can answer in a comment box. Okay, you have correctly answered the previous question. Very good. Try to answer this question also. Okay, again you are saying B. Very good. Option B is the exactly correct answer. Actual sales minus break-even sales. Okay. So basically margin of safety, right? Margin of safety is actually the thing which tells you how much your sales, okay, fall before starting making the loss. Am I right? So how much your sales fall, getting it, before starting the loss. So formula for that is actual sales minus break-even sales. Great. So more the margin of safety, more the safer business, and the less the margin of safety, the business will be in the more risk. Getting it? For example, if your sales are rupees 1 lakh rupees and your break-even sales are rupees 70,000, so margin of safety will be 30,000. Getting it? So if your sales can fall by 30%, then still you won't be in a loss. Getting it? If your sale is fall by 30%, that means 30% of 1 lakh rupees, 30,000. Getting it? So we have a margin of safety 30,000. So you will be not in the risk. Your business will not be in the risk. Okay, because margin of safety is already you have 30,000 and the 30% sale is falling. Getting it? So there will be no changes, there will be no risk in the business. Getting it? That is why we need to calculate margin of safety. It will give you the idea about how much your sales can fall before making the loss. Getting it? Understood, Dimple? Chalo, next question. In a standard costing, material price variance, we call it MPV. Okay, so what is the formula of MPV? A. Standard price minus actual price into actual quantity. B. Actual price minus standard price into standard quantity. C. Actual price minus standard price into actual quantity, or standard price minus actual price into standard quantity. What will be the correct answer? Give it in a comment box. Am I clearly audible to you, everyone? Audio, video, both are clear? All right. So right answer of this question is option C. Okay. Actual price minus standard price. Okay, great. Into actual quantity. Okay. So MPV is equal to actual price minus standard price, right? Into actual quantity purchased. Correct. A favorable variance when actual price is less than standard price gives a negative or favorable result if using the conventions. Okay, the formula captures the price difference on an actual quantity. Actually, it is saying about the formula. So when you buy raw material, you expect to pay a standard price, correct? If you are buying the raw material, you are expecting to pay the standard price, right? But in reality, you may pay actual price, right? In the reality, you may end up with the paying the actual price, AP, right? So the difference between them multiplied by how much you purchased is MPV. Understanding how it is calculated? When you are buying a raw material, you are expecting to pay the standard price, which is the regular price, correct? But in reality, you end up with the paying the actual price, right? And so difference between these both will be multiplied, and how much you have purchased, which is multiplied, it is called MPV. That means into actual quantity purchased. Getting it? So that is the formula. MPV is equal to AP, right, minus SP into AQ. That means actual quantity. Getting it? So basically, for example, we can take if manlo, if your standard price is rupees 5 per kg and your actual price is 4 per kg. Okay, rupees 4 per kg. Getting it? So the actual quantity is actual quantity is 1000 kg. Getting it? Actual quantity is 1000 kg. So MP will be what? 4 minus 5. That means standard price 5 rupees kg and actual price 4 rupees kg, right? So actual price 4 minus 5 into 1000. Okay, so it will be into the in the minus 1000. The answer will be in the minus. Getting it? So it will be favorable because you save the money. Understanding? Because you have saved your money, so that is why it is called favorable, because it is in minus, right? So this is what your MPV, material price variance. Clear hai? Chalo, next, material usage or material quantity. Okay, the variance formula is material usage variance formula is, okay, which we call it MUV. Okay, material usage variance. Standard quantity minus actual quantity into standard price, or B, actual quantity minus standard quantity into actual price, or C, actual quantity minus standard quantity into standard price, or D, standard quantity minus actual quantity into actual price. Okay, give your answer. Namaste, Ambika. Formula of what? Stand. Right, right, right. Got it, got it. उल्टा पुल्टा हो गया ये. Great, great. Very good, Dimple. You have noticed that. Very good. So the actual formula is standard price minus actual price. Okay, not the actual price minus standard price. So the answer should have this. Sorry, this one. A, B, C, D, whatever it is. Try to answer, because in this examination, there is no negative marking. So whatever, if you know the answer, if you don't know the answer, just try to give the answer. Okay. If you know the answer, that will be great. If you don't know, try to attempt the answer. Okay. Never know. you will end up with the selecting the correct answer even if you don't know the answer, right? So you will have a great marks. So try to practice with the attempting all the questions. Chalo. So right answer is option A. ठीक है? Yes, Sambika, very good. Right answer is option A, standard quantity minus actual quantity into standard price. Correct? See, material usage variance standard quantity allowed for actual output minus actual quantity used into standard price. Okay, so basically this is about how much material you have used, right, versus how much you were supposed to use, right, for the given production. So that is the difference, which is MUV, correct. If you use the less material, getting it, if you use the less material, that will be favorable, and if you waste the more material, that is adverse. Getting it, it is the opposite to that. So basically when you are using the less material, right, and the production is what we can say, the good production quantity, right, so that will be favorable, we call it favorable. And if you are wasting the more material, that will not be favorable, that is adverse. Clear? So the formula for that is standard quantity minus actual quantity into standard price. Clear? Understood, or do I need to give an example of this? Understood, Dimple? Ambika? Okay, let's move to the next question now. Next question is about variable overhead efficiency variance is computed on the basis of, okay, variable overhead efficiency variance. Okay, A is computed on the basis of A, actual hours into standard rate minus budgeted variable OH. Okay, OH means overhead. Okay, B, standard hours minus actual hours into standard variable overheads rate per hour. Clear? Then actual hours minus standard hours into actual variable overheads rate, or option D, standard hours minus actual hours into actual variable overhead rate. Give your answer. Okay, so right answer is option B. Okay, the standard hours minus actual hours into standard variable overhead rate per hour. Okay, basically overheads like electricity, indirect labor are often observed based on the hours, right? Like machine or labor. Getting it? If you finish work in fewer hours than standard hours, if you are, then you are efficient. We call it efficient, right? If you are finishing your work than this within the given standard hours, it will be efficient. Favorable variance, we call it, right? Got it? Okay. Next, fixed overhead volume variance arises because A, actual fixed overheads differs from the budgeted fixed overheads. B, capacity utilization differ from the expected, causing difference between the budgeted and absorbed fixed overheads. C, variable overhead spending differs from the standard. Or D, sales mix differs from the budgeted mix. Okay, the right answer is option B. Okay, that is capacity utilization differs from the expected, causing difference between budgeted and absorbed fixed overheads. Okay, see, the variance comes because actual activity, the production level is different from the budgeted levels. Getting it? And the formula we have seen, the budgeted fixed overheads minus absorbed fixed overheads based on that standard hours for actual output. Getting it? So right. So if you work less than expected, okay, that is the adverse variance. And if you work more than expected, that will be favorable variance. Okay, it tells us the whether we used our capacity like machines, labor fully or not. Getting it? Whatever we have, the machines, labors, or the capacity we have. Okay, we have used our more capacity fully or not. That will be that will be told by the fixed overhead volume variance. Getting it? Next, sales margin variance is caused by, okay, sales margin, that is profit. Sales margin variance is caused by difference in actual sales quantity only, B, difference in actual selling price only, C, difference in both price and quantity from budget only, or D, difference in cost only. So right answer is option C, difference in both price and quantity from budget. Okay, the difference in profit can come from two sources. One is sale price variance, second is sales volume variance. Correct? Eh? Sales price variance is what? It is did we sell at a higher or lower prices than expected. Okay, have we sold our product at a higher or lower prices than expected? That is your sales price variance. And when the sales volume variance is there, whether we have sold our product more or fewer units than planned, that is comes under the sales volume variance. Understanding? Getting it? So basically, sales margin variance, right, is price variance plus volume variance. Okay, so there are two sources: sales price variance, which is calculated for understanding whether we have sold our product on a price that we have expected or not, and the sales volume variance, that is our product we have sold on a fewer units or more units than we have planned or not. And the sales margin variance is combination of both price variance and volume variance. Getting it? Next, in standard costing, which variance is controllable by factory superintendent? Material price variance, material usage variance, sales price variance, or fixed overhead expenditure variance? What is it? It is option B, material usage variance. Okay, material usage variance. See, basically, the material usage, that means the efficiency. Getting it? The variance which is arises if the actual material consumed is different from the standard. Okay, whatever the standard usage is there, the actual material is consumed. Okay, that consumption is arised, okay, from the standard. Getting it? That is the material uses efficiency variance responsibility. Getting it? So see, so controlled by production or the work superintendent, because it manages the supervision of workers, the waste controls, production methods, right? Getting it? So that is why the material uses, the efficiency is typically controllable by the production work superintendent through the supervision, waste control methods. Getting it? Understanding what I'm trying to say? Basically, the material uses, okay, that means the efficiency, right? It is typically controllable by the production or the works, we call it. Getting it? Through the supervision. Supervision is what? Supervision of workers, supervision of waste control, supervision of production methods. Getting it? So fixed methods overhead expenditure may be management, finance, sales price, marketing, material price is purchased department. Okay, this comes under this material uses variance responsibility. Getting it? Next, which department is mainly responsible for material price variance? Purchase department, production, sales, or accounts? What is it? So right answer is purchase department. Okay, what is it? Purchase department, right? So material price variance arises due to the difference between actual price and the standard price of material, which is under the control of the purchasing department. Okay, it is arises due to the difference between the actual prices, actual purchased prices, and the standard price of materials, right? Which is controlled by the purchasing department. Okay, labor efficiency variance is generally the responsibility of personal or HR department, factory or production department, purchase department, or accounts department. What is it? It is factory or production department. Okay, clear, everyone? So labor efficiency depends on the supervision, working conditions, methods, and moral. Typically, the responsibility of the production works manager. Okay, the responsibility lies with the production or works manager, right? Because it depends. The efficiency depends on the supervision, working conditions, methods of work, then worker moral. Getting it? So that is why it is the production or works manager. Clear? Okay, so I hope you have understood all the questions. Okay, okay, this is not enough. If you need, we can take more questions on it in the tomorrow's session. Just let me know in the comment box. Shall we go for the more questions tomorrow? Say yes or no in the comment box. We'll have a session tomorrow also. Quickly say it in the comment box. Shall we have the new session tomorrow? We'll have some more questions on the same topic. Okay, no issue. We'll have one more session tomorrow on the same topic. We'll cover this topic again. Okay, the different questions, the different explanation, and different methods. Okay, and maybe in tomorrow's session, those questions will be practical questions. So do not miss the session. Okay, sure. Bye bye. Have a great day. See you in the next session.